After I finished my service as a lone soldier in the Israeli army, I realized this was my defining moment. It's time for me to build success, create stories, and the financial freedom that I never had before. I used to be trapped with money, and now it empowers me. Since then, I've developed a multi-million-dollar financial advisory business, a podcast that has been featured on all the global media stations around the world. One of my favorite things to do is educate people on the mindset to build resilient wealth, build success, and have fun doing it. In my show, you will not only get best-of-class tips, amazing stories, a bunch of laughs, but you'll also get a mindset shift from a family of people who have come from nothing and will help you be ready to succeed. Welcome to the Resilient Riches Podcast. And see all these different tokens. We don't know what they are, so we thought let's just bring an expert, Yael Tamar, who's actually rated one of the top influencers across the world when it comes to cryptocurrency, comes to different types of tokens, comes to real securitized assets. So Yael, thank you so much for coming on the podcast. It's been a big question of ours. What is all this stuff and what's all this digital asset? And we thought let's bring somebody on to talk about it. So Yael, thank you so much for coming on, raining out of Tel Aviv. So Yael, if you can intro yourself, and then we'll get right into a bunch of questions.
Thanks for having me, Yair. Really excited. And yeah, let's break it down for everyone once and for all. What crypto is, why crypto, what other assets are there beyond Bitcoin, Ethereum, and a couple of other usual suspects, and how we can use them, how you can invest, how you can learn about it, and why should you care? So that's what I think most people ask me on a daily basis. And I'd be happy to share that knowledge with you guys because it's important. It's an industry that's changing the world.
Yeah, I remember we redid our website, and it was somebody out of Venezuela, like a Jewish guy out of Venezuela, and I'm talking to him, and I said, "Hey, how can I pay you?" I'm like, "Can I PayPal you?" He goes, "No, I don't use PayPal. You have to send it to me via crypto." And I was like, "That's weird." And then years ago, I was in Africa, and the banks ran out of money. Like, it was an actual problem that I couldn't go in and pull money out of like a Zimbabwe bank to pay for food or whatever. Like, it was bizarre. So you had to interact with cell phone credits, like minutes on your cell phone, and you would barter with cell phone minutes because it had some value to it. So, I mean, if crypto was really prominent there, that would have been the solution. So what is cryptocurrency? What are the functionalities of it? What are these assets? And let's just get into the basics.
Sure, Yair. And great that you brought up this topic of, let's say, Africa, and they have this common denominator for financial applications within different African countries within the continent, is that they have telecom companies that really operate minutes as a currency. So that's a really interesting technological / compliance combination that prepared them for crypto, which, by the way, right now is used in a lot of African countries as well, combined with foreign exchange, combined with bank functionalities. So obviously, where you have countries that have a lot of unbanked individuals or infrastructures that are not as developed as, let's say, the US and Europe, you have much more innovation happening and also more need for payment solutions. So we see a lot more adoption of crypto coming out of Africa and South America. But now it's also finally come to America. But the difference is that in America, in the US, you have large companies, fintech companies, pioneering crypto behind the scenes. So a lot of people don't even know that crypto infrastructures are being used. And so the reason why I chose to bring that introduction in is because crypto essentially crypto can be talked about in the context of the asset itself. So like US dollars or euros or pesos. You have Bitcoin, Ethereum, Cardano, Solana, and those are coins and they have value and you can buy them and you can also use them to transact. So those are currencies. We can also talk about crypto in the context of technology and the payment rails, the payment infrastructure, the transaction infrastructure that is used. And that technology is generally called blockchain. And that's the technology that enables transfers of crypto. So far, so good.
Yep. So basically, there's the actual dollars, and then me sending the dollars to other people is the blockchain.
So the blockchain is the general infrastructure. So today, let's say you can be sending your dollars via banks that are using Swift, which is basically the technology that they've developed to do interbank transfers outside the U.S. Globally, and inside the U.S. you have ACH and you have other systems. So blockchain is essentially a system that was developed in order to create an ecosystem that doesn't depend on any one agency. So Swift, for example, is an agency all in itself. In order for it to work, you have a company, and that governs essentially this infrastructure. And if you're using if you're using your banks, obviously, let's say that you want to send me $100, right, for a service, then essentially, if you're not in the same city as I am, where you can come and give me some cash, you can do a bank transfer, right? You can do a PayPal transfer. You can, if you're in Africa, you can use a telecom company, which still is a company that facilitates a transfer, right? There's other solutions in the US. There's Zelle, that's Bank of America, and then there are a couple more, right? So Venmo. So you can Venmo it, right? Venmo is a company. So you're basically, the way that it works is that it basically takes $100 from wherever it sits with you, either a credit card or a bank, right? Or maybe you already deposited it. So they know that you have the money. And then they essentially take the money and then they put some numbers in my account, right? So essentially they're moving these digital money from one place to another. And they just want to make sure that they got the money from somewhere. So
Gotcha.
that's, and how can you do this? But let's say we don't want to use Venmo. We don't want to use PayPal. We don't want to use a bank. But you're not in the same place with me to give me cash, or maybe you don't have any, right? Because you're in Africa. But what do you do? And so the brilliant people, we don't know who they are, but they came under the pseudonym of Satoshi Nakamoto. And I think it was 2009 or around that time, came up with this methodology called the blockchain. At the moment, they called it basically Bitcoin chain. There was Bitcoin was the name of the blockchain and the name of the currency itself. And the idea, if you read the white paper that came out to explain how all of this works, the idea was to enable transactions that are not dependent on any single party. That you can actually start transfers without having an account. You don't have anybody that needs to approve you. You can join. You're gonna have to pay for a transfer, right? You're gonna have to pay a little bit for the electricity that is being used, essentially, and for others who facilitate these transfers, right? Who provide this electricity, and either generating it or buying it from the grid. And this magical system verifies the transaction. It has to verify that you have $100 on your wallet. It has to then verify that your wallet exists, my wallet exists, right? And then nowadays you also have to specify which blockchain you're using most of the time. So back in the day it was just Bitcoin. And so you're basically sending this, and then the system does the same thing. It erases 100, well, not doesn't really erase, but let's say it withdraws 100 whatever units from your account and puts it and credits it in my account. So it actually does travel. That's the beauty of it. That in the bank will just erase some numbers from one place and put them in another place. And the same will be on the apps. In case of Bitcoin, the Bitcoin actually travels. It's an asset. It's an actual asset, right? It's backed by Bitcoin. It's funny because most people think about the virtual assets as these fake assets that are not backed by anything. That couldn't be further from the truth, because in this situation, there was actually assets that were issued, right? And they're minted and issued all the time. This is how Bitcoin works. We have miners, so to speak, that mine and mint this currency,
Mm-hmm.
like the U.S. government that prints the dollar, for example, or but in this case, it's minted by the ecosystem. A lot of people together, institutions that are sitting there and doing, and they get paid for doing that with Bitcoin. And actually, when you're sending Bitcoin, the actual Bitcoin travels from one wallet to another. That's why there is no possibility to erase anything from Bitcoin, from the blockchain ledger. And if somebody's trying to erase, they essentially, are sending Bitcoin somewhere else. So that's why it's also a really great.
So it's safer.
Yeah, it's definitely safer, unless, of course, somebody gets a hold of your Bitcoin wallet, and there's no reversing this transaction, right?
Yeah, because
so,
you're actually sending it over. It's not like the banks
yeah.
aren't doing the transaction. Very interesting. So,
Yeah.
Okay, so that's how its actual understanding of how the actual movement is.
Yeah.
But let's talk about the investment side of it. Like, why are people investing? Why is it so volatile? Why was it up whatever to 100 something thousand, now down to 80,000 so quickly?
Yeah.
What can we talk about that?
Wow, that's a huge, huge area and conversation.
It's hours that we have 5 minutes max.
I know, right? So let's just say that from the history of Bitcoin, initially Bitcoin was very useful for transactions, and you could get paid, you can pay, but it's also slightly expensive for transactions, especially for small ones, right? Like if you're doing a couple of bucks, like the whole the transaction could cost more. The cost of the transaction could be more. So the evolution so happened that nowadays you now have what's called stable coins. So you have a crypto version of US dollar, so you don't have to worry about the volatility when it gets transferred, right? So most people don't use Bitcoin and Ethereum to make transactions from one to another. You don't need that anymore because you have other options in this evolution. We've been in this game for over 15 years now. So now we've evolved that for transactional purposes, we're using what's called a stable coin. It's usually pegged to the actual currency, US dollar or euro. And so why is Bitcoin still interesting? Well, actually, since it's no longer, it can be used for payments, and it might be in the future. But the most interesting thing about Bitcoin is that it's the only currency in the world, or the only money, that is fully decentralized, and it's not tied to any government. And if in the beginning there was a bit of skepticism, and a lot of investment banks said we're not touching it with a 10-foot pole, today every single investment bank is heavily invested, or large ones at least, are heavily invested. In 2022-23, the presidents and CEOs of large investment banks like BlackRock, JP Morgan, and others that basically are saying, we're all in on Bitcoin, and this is one of our obvious strategy is to invest. U.S. government is invested in Bitcoin, and it's not going anywhere. And institutions are heavily relying on Bitcoin or another crypto for liquidity. Now, let me get into the answer to your question. Now, given what I just said, right, that institutions and individuals as well are relying on this highly liquid asset, because remember, you can buy it anywhere. Well, not anywhere. You can buy it through exchanges, or you can even buy it over the counter, as they say, from other individuals, right? You have to be fairly brave to do that, to send somebody cash and get Bitcoin. So most people don't do that anymore. They buy it through exchanges, and most institutions, they do transactions in millions and sometimes billions of dollars, right? When they buy and sell Bitcoin. Now, first and foremost, it's an asset that is highly volatile, so there's a lot of trading going on, and people buy low, sell high. So everybody's waiting kind of for these magic numbers, and the last one was 120. So once it kind of reached 120, a lot of people just set kind of this automated sale order at 120 to start selling. But moreover than that, nowadays Bitcoin gets influenced a lot from institutional strategy for liquidity. And if essentially banks or investment banks, they need to lower the risk of their portfolio so that they can get more loans. So you can think about interest rates, right? If your audience is pretty savvy, as far as I understand, savvy investors, they understand the influence of the interest rates and other economic activity. So once you have some sort of a movement, let's say money became more expensive because interest rates went up, then what we'll see is institutions that want to borrow at better terms, they might temporarily drop crypto from their balance sheets to reduce their risk level. And that's just in general to show that once the institutions entered the game, then we essentially look at Bitcoin as this kind of volatile and risky asset because that's just how they are rated by different lenders. So that's one of the reasons. Another thing that you can see at times is that Bitcoin, it can be correlated with S&P 500, and that usually happens when people have more money because, let's say, economy is doing really well, or maybe there are lots of exits, or some sort of an event happened, and people are making a lot of money from stocks, and then they're like, okay, what should I buy now? And then they notice that Bitcoin is on sale because in that particular period, like it coincided with another event where institutions had to dispose of Bitcoin. So now it's on sale. So people jump to Bitcoin or crypto assets. And other crypto assets are generally correlated with Bitcoin. So the cool thing about crypto, however, is that it doesn't have a single correlation to a single asset class. And that is really interesting because you don't, essentially it's a diversification strategy in a way to be investing in this asset class.
Gotcha. So let's talk about, just for time's sake, let's talk about alternative coins and alternative assets that we were discussing before we started the podcast. Can you give like a quick summary what that is? Like, I know there was a big time that people were buying NFTs and people were buying all these other digital assets. Can we talk what that is, what the future looks like?
Yeah. So investors are trying, and companies are trying to differentiate a bit out of Bitcoin, not very successfully. However, there are companies that are actually working as infrastructure for fintech, for financial technologies. So like Ethereum is essentially the rails or the infrastructure for most of the fintechs out there. There are a couple of other blockchains that are sitting on top of Ethereum. It's more like a wholesale or like back in the day in telecom, they used to call it the MVNO. And then there's on top of it, there is, let's say, a more consumer friendly layer, which is cheaper for transactions. So like Solana, Cardano, and so all of them have coins that are used to operate the infrastructure. So users will pre-buy or buy the coins and then use them to pay for services, essentially. So that's what those coins do, and they do exist. Most investors that are not explicitly crypto traders, what they will invest in is they'll look at crypto ETFs. And there are a couple of out there. There are Bitcoin ETFs, of course, but then there's also more diversified crypto ETFs. And then they don't have to worry about individual coins. That's the first question that you asked. And the second about NFTs, sometimes there are different asset classes within crypto that come up and become a bit of a hype and interesting. And those are slightly risky, but also kind of cool things because you get to also explore what other options are there. And so that there was all this craze about different, say, Bored Apes and other types of art that blockchain is great for establishing the validity, authenticity of something that's digital. And so that was for a minute an interesting development. Now that hype has passed largely, but what has stayed is that NFTs are used for certain applications, like within the applications, and we don't even know. But this infrastructure that was built out is certainly used for lots of fintechs. And so now there are stable coins, of course, and which
so let me break it down. Sorry to interrupt you. So the stable coins are like pegged towards the U.S. economy, and that's what people are transacting with. Bitcoin is more of a digital asset investment strategy that
Yes.
people are having in their portfolios.
Yes.
Then you have these altcoins that
Yeah.
you were talking about
They're
that are
usually
used
similar.
to purchase
Yeah.
services, and
Yeah.
like people will go, hey, I'm going to transact using this coin.
Yeah.
So it's much more nichey into that space. And then
Yeah.
Ethereum is a lot of like the backing and the blockchain
Yeah.
behind
Exactly.
behind other companies and what they're building their financial technology
Fantastic.
on top of.
Fantastic. Just to clarify a bit about
Cool.
the altcoins, a lot of investors just invest in altcoins without ever using them, within the ecosystems where they were intended. Just
Yeah,
like
like Doge was a
yeah,
Doge was a big one.
exactly. So they're just used for investment purposes. They're pretty small niche markets. Usually they're blooming when Bitcoin has had its season. Let's say it went up very high, so
Yeah.
people will sell Bitcoin, buy a little more altcoin. So so majority of the investors are not really trading them separately unless they're specifically crypto investors, but you can get exposure to them by investing in baskets of currencies, which usually have majority Bitcoin, a little bit of Ethereum, and then a bunch of others.
Cool. All right. So I'm going to stop us off here. My dad has a lot of questions, but just to remind my father, questions are typically one sentence long. They end with a question mark. So I just want to know, because my dad's going to go into his thing. So I'm going to let him jump in into that. Father, you can jump on. I'm going to mute myself.
Yeah, and I'll make sure I have a question mark at the end. But it's great to meet you. I mean, it's been a fascinating discussion here. I mean, this is something that I really didn't understand, and I made a lot of notes, and it's brought me a lot of clarity to me, and I'm sure to a lot of the people that are going to be listening to the podcast. But let me start off with a question. I mean, it sounds to me like it's like a big game of Monopoly. That's what it sounds like. Like everybody's agreed that we're going to play this big game of Monopoly, and the price goes up and down based on supply and demand. And that's what it seems like. So if the demand craters, the price goes down. If for some reason the price goes up, and you mentioned something at the beginning, which I was going to ask about some explanation. You mentioned that a lot of people are using crypto without even knowing about it.
Correct.
What does that mean?
So crypto technology or crypto rails and fintechs and banks, now within international transfers, a lot of the banks are using crypto. If you're a business that is involved in, let's say, loans and syndications, and most investment banks now will use what's called a tokenization or a security token. And so the largest investment banks, they use it automatically. 2 months ago, Larry Fink the CEO of BlackRock was in Saudi Arabia in a conference, and he basically said, forget AI, or at least he said AI is interesting, but tokenization, we're going to see all of the assets tokenized, and essentially all the transfers of the assets, and which were, assets that were not liquid, we're going to be able to make them more liquid, and so on, right? So they're all hyping up on tokenization. So I think a lot of people, when they're using apps, especially fintech, especially payments, PayPal. Now, MasterCard has a lot of applications with crypto. So if you're using MasterCard, chances are that they are using cryptocurrency networks and technology within their stack. So potentially every time you're using MasterCard, or some of the times you're using PayPal, it's using crypto on the back end because that's the cheapest way to make transactions. So you don't have anybody pushing the papers. It's automated. Everybody's excited about AI now because it's, allows full automation. So AI helps automate decisions, while blockchain helps automate transactions and infrastructure services.
Okay. Could you just what does it mean, tokenization? What do you mean by that?
Yeah, it essentially means to digitize something that was off the real world, let's say. So, by the way, credit cards do a fabulous job of tokenization on a separate set of technology rails. So they used to just use whatever scripts that were available to programmers to take cash and digitize it so that you can actually pay in a store. And everybody has to play the game. You have to have a POS system, right? And you have to also have the banks play the game, right? Because that's where people store their money. So you have a lot of players. Now, imagine that you can do all of this with just having a crypto wallet on your phone. Like you can go to the store and pay. Like if everybody was using crypto, let's say if I had a store and you had a crypto wallet, then you can technically come and buy from me. And then their accounting, obviously software, taxes and other things, not a problem anymore. But most people are still not there. So what happens is that there are companies now, for example, Square, which essentially is now going to enable 4 million businesses in the US to take crypto. But tokenization essentially is you don't only tokenize cash, which is what stable coins are essentially. They're tokenized cash, dollars, right? And in fact, in order to create a stable coin, you must put actual money in the bank under someone's custody and then issue per that money a dollar, right? A digital dollar. So, which is funny because the actual non-digital dollars are not backed by anything, but so think about that. And so you can also tokenize real estate. You can tokenize stocks. You can tokenize commodities. So essentially, if there's a fund somewhere that holds various assets, you can break that fund into these digital units and then sell them to people. Without having an exchange, without putting them on NASDAQ. So imagine where that opportunity can lead us. And that's what my company does, Dibs Capital.
It's fascinating. Everything's fascinating. Thank you.
Yeah, it's really beyond. Yael, can you tell us where can people find you? How can people get connected with you? Give us your shameful plug.
Everywhere. You can Google me at Yael Tamar. You can see us on dibscapital.com, all the social media. LinkedIn's probably the best way to reach me, or Yael at dibscapital.com. And we're working with family offices, investment banks, broker-dealers to tokenize private equity at the moment. That's what we're focused on. We were the first pioneers in real estate. Now we're focused on private equity and listing of aggregated vehicles like ETFs that are essentially enabling liquidity for private assets.
Cool. Amazing. Yael, thank you so much. We really appreciate you coming on and sharing your insight with our listeners. Thank you, everyone. We'll see you on the next one. And don't forget to like, subscribe, share with your friends, and build a lot of wealth and make a lot of money. That's really our goal here. Welcome, everybody, to goodbye, everyone, from the Resilient Riches podcast. I'm just going to do the intro now when we'll edit it out. So just give me 30 seconds and bear with me, and my dad will critique it because he likes to critique it. The world of crypto has changed so much over the last 15 years. It started with just an idea. It became something that people were skeptical. They never said anything would happen. Then all of a sudden, we see the 25-year-old down the street, and he's buying Ferraris and Bentleys and huge houses in cash. And everyone's confused, like, hey, what happened? They go, oh, he's a crypto billionaire. He's made his money in crypto. So we wanted to bring someone today that can actually understand the difference of what is going on with the crypto market, what is the blockchain, and what is the new trends that people are doing and investment banks are doing, tokenizing and creating securities that are linked to crypto assets or linked to and linked to building wealth in that sphere. The key is to understand it. The key is to be engaged in it because it is here and it is growing across the world. Yael Tamar is going to be on today. We're really excited to have you on. Thank you so much for joining the Resilient Riches podcast.
Thanks.
Klyman Financial is a DBA of the Partners Wealth Management and SEC Registered Investment Advisor. Registration does not imply a certain level of skill or training. This podcast is for informational and educational purposes only and should not be construed as personalized investment advice or a recommendation to buy or sell any security, cryptocurrency, token, NFT, or digital asset. All investments involve risk, including the possible loss of principal. Past performance is not indicative of future results. Advisory services are provided only to clients of the Partners Wealth Management pursuant to a written advisory agreement and only where legally permitted. Nothing in this podcast constitutes an offer to provide advisory service. This podcast may feature guests who share their expertise or personal experiences. These statements should not be viewed as testimonials of advisory services nor as endorsements of Klyman Financial or the Partners Wealth Management. No compensation was provided for participation unless otherwise disclosed. The reference to third-party ratings or designations, such as being rated the top influencer, constitutes a third-party rating under SEC rules. Such ratings may not be representative of any client's experience and are not indicative of future performance. Klyman Financial and the Partners Wealth Management did not compensate the rater for this designation.